name is Andrik Cordero. I'm a financial advisor and the founder of Grow With Me, a full-service investment advisory firm. Today in this video, we're going to be talking about inflation. Many of you in the audience are familiar with inflation because you've experienced it in your daily lives. The price of the movie ticket that's gone up over time, the price of the poultry that you purchase at the grocery store that's gone up over time. However, conversely, you've also experienced deflation in certain areas of your life, predominantly in the areas of technology. The TV that you can buy today is much cheaper than it was 10 years ago. So what exactly is inflation? Well, that's what I want to unravel in this video. So then in the future, you can then look at the news and understand what that means when you see inflation and you see these headlines of inflation, and you can make better informed consumer decisions based on that. Secondly, what I would then like to do in the second half of this video is take some time and talk about some investment ideas for periods of inflation that might perform well. In no ways is this an investment recommendation. Investing always comes with risk, and understanding your unique circumstances and preferences is very important when you are going to invest. Inflation can be measured with the simple economics equation of money supply times velocity of money equals real GDP times price level. To give some context of what that equation means, I'm going to give an example or scenario. Let's say we're in an economy that has a fixed amount of goods and services that's produced. There's only so many cups of coffee, there's only so many planes flying, everything is fixed. If the money supply is also fixed, then we have this price equilibrium, right? So now, let's say we suddenly double the amount of money in the economy, but we have the same amount of coffee that's produced and the same amount of planes. Well, it makes sense for the coffee to go up in price because we're, as a group, only producing the same amount of stuff, right? On the other side, there's another scenario that we could then have happen where we keep the money supply fixed, but instead what happens is money changes hands much faster, and this is the velocity of money. So if I'm buying and selling and everyone else is doing the same, what's actually happening is there's more cash flow circulating, and over any period of time or a fixed period of time, you're essentially having more money flow through or more income. And if you're producing the same amount of stuff, same amount of coffee, same amount of planes, it makes sense to have inflation or the price level go up. So inflation is usually measured with the term called CPI, which stands for Consumer Price Index. This is put out by the BLS, the Bureau of Labor Statistics. There's also two sub-indices, which the CPI is usually shorthand for CPIU and the CPIW. We're only going to focus on the CPIU or the CPI, which really it's just, the CPI is a basket of goods. And the basket of goods for the CPIW is a little more specific, and it excludes more people out of the economy. So the basket of goods for the CPIU, according to the BLS, comprises or captures 87% of people in America. So it usually matches up with what people are buying. So then they take that basket of goods and then they track it over time and say, is that basket of goods going up in price or is it going down in price? Well, if we think about consumer preferences change within the year. So that is where this idea of seasonality and non-seasonality comes in. So the BLS also publishes a CPI that is seasonally adjusted and unseasonally adjusted. So the seasonality is, we have the holidays and it's Christmas and people are spending more money during the holidays than they are maybe during March or April. Also, during winter, during summer, during vacation, school getting in and out, all these things have factors on consumer preferences throughout the year. So the BLS basically takes that and tries to smooth it out so that you can compare over periods of time and say, hey, what's really going on with the price if we smooth that out? Now, what you're essentially doing is creating this kind of artificial price level that's not reflective of what's going on exactly in the economy at a specific moment. And so that is where unseasonally adjusted data comes out. And that is what we're going to be referencing, because that represents the price level more accurately than seasonality does when you factor that in. So a question becomes, is CPI a cost of living index? And it is not. According to the BLS, it is not. Because a cost of living index would kind of imply that we have some sort of standard of living or some sort of utility that we should all be deriving as humans and saying, I expect to have a certain quality or standard of life, and the CPI doesn't really capture that. It covers the idea that prices of things are going up, but it doesn't say, hey, that matches up with your standard of living. So you could think of it as a modified standard of cost of standard of living, if you want to think about it like that. The other thing is the CPI a comparison for places in different parts of the economy? No, for kind of the same reason, because a cost of living index would imply a certain standard of living, and it's really hard to compare those standards in different pockets of the economy. So New York versus Texas versus Florida versus Wisconsin, it's all very different. And so the CPI is simply just saying, hey, a basket of goods is going up in price over time. So the BLS puts out the CPI weightings, and it is a very lengthy description of what all goes into the CPI index. And I will attach the link in the description, so if you're curious, you can look at it and see all the different weightings. However, the really big weightings, or a big chunk, one of the largest is living, so shelter. Shelter accounts for about a third of the CPI index. Food and energy are also a big factor in the CPI index. So food and energy is about, let's say, about 20% of the CPI index. And then you have shelter, which is about a third. So if you think about that, those three items are about half of the CPI index. The CPI index also has the weightings change frequently. So that's why I don't want to give too technical or too detailed on specific weightings, because over time, those weightings are going to change. Now, the rule of thumb of saying food and energy are big components of the CPI index, and so is shelter, those are going to hold true. Now, the BLS weights these things, right? And they just assign a weighting and say, this is how much is the weight for the CPI index. Technology is very low. So if you look, technology is only about a third. So your phones, your tablets, that's only about 1/3% in the CPI index. So it's weighted very, very low. And so the CPI index is not necessarily an indicator of how much time or where we're allocating our time. So we all know that we're spending a tremendous amount of time on technology and phones and all things tech-based, but that's actually not a huge component of the CPI index, which then brings me to this idea or point of your personal CPI or your personal inflation rate. And that is the idea that as consumers, we all have different preferences in what we're spending. So if you have a paid off house and you eat mostly vegetables versus you eat a lot of meat and you're a renter, those are different scenarios in what inflation means to you. Now what I would like to talk about is the theories or economic theories linked to this idea of pushing inflation. So there's three predominantly. There's demand push, there's cost pull, and then there's built-in inflation. So demand push is the idea that consumers say, hey, we want more, we want more, we want more, right? So you keep trying to purchase these goods and services, and there becomes a bottleneck on the idea of saying, hey, we only have so much, right? And so now you're pushing this price up. On the other side, you could look at it from the business perspective of the business trying to create those products and services, which is cost pull. So the business is taking the inputs and they're putting it into their product, and it becomes more costly, it becomes harder to create that product, and so then they have to pass that on to the end consumer. So that's this cost pull inflation or built-in inflation. And that's an interesting idea of saying, hey, inflation is going to be constant over time. It gives consumers an idea of what to know in the future so they can plan for their future. It gives them this built-in idea of knowing how much, you should give a raise to somebody, how much money that it makes sense to raise your prices, at the coffee shop. That is this idea of built-in inflation. Now I would like to take a second and talk about the Federal Reserve and where their role in all of this is. The Federal Reserve is the one to control the money supply. They're independent from the government, and their whole job is to control the supply of money. They can do this a few different ways, one of which is raising interest rates. But the Federal Reserve has really three missions, and that is to have maximum employment, moderate long-term interest rates, and price stability. Moderate long-term interest rates make sense because we have had interest rates, or we have had a credit system for a very, very long time, thousands of years. This idea that if you lend money out, you should be getting interest, or you should be collecting something for lending your money out. And so that incentivizes lenders to lend money out. Otherwise, there would be no incentive. And so that is one of the first things that the Federal Reserve kind of facilitates. Maximum employment makes sense in saying, hey, we want to have more people employed. It's better for everyone. And then this last one is kind of interesting about price stability. And this is really what connects to the idea of inflation. Because the Federal Reserve wants a little bit of inflation. Actually, typically they target 2 to 3%. Reason being, that stimulates the economy, right? We want money to be flowing. If we think back to the velocity of money, we want money flowing through the economy. Now, we don't want too much money going around in a circle, because then what happens is now you create this really hyperinflationary pressure, which is not good for the economy. And then you also don't want nobody spending money or deflation. It sounds great, deflation. We don't want inflation. We don't want our dollars to be less in the future. But we also don't want deflation, because then what that encourages is nobody to spend. Because if you knew your money was going to be worth more by just holding on to it, you're not going to want to do anything with it. Now, what are some things that we can do as investors to protect or hedge ourselves in an inflationary environment? One of the first ideas is commodities. Commodities would be like sugar or cotton. So the inputs that end up creating these outputs that we use in our economy of goods and services. You can buy commodities through futures contracts, or you can buy an ETF that holds commodities contracts. So there's different ways of purchasing commodities, but essentially what you're doing is you're buying the commodity, right? And if we think back in how the CPI is weighted, right? The CPI is weighted with the idea of food and energy being a decent component. And now, if you think the weighting scheme is related, okay, well, it makes sense that commodities could have some correlation there. Also, if a company needs to price their products higher, why is that the case? It's usually because the inputs are more, right? And the inputs are usually commodities. Natural resources, energy, infrastructure, that's also another idea. Companies that are in these areas come back to the idea of transportation and energy, which is somewhat related to what I just spoke about commodities. Because if you have energy inputs, or you have inputs, if you're thinking of the inputs of something and these inputs are going up, companies that are in the business of inputs might have a higher degree of ability to pass on those costs. Now, if you buy a company and you buy an energy company, and just because they're in the business of energy, and energy has an inflationary pocket to it, and you're having this inflationary period, well, that doesn't necessarily mean the company will do well or the stock will do well. You have to make sure you do your investor due diligence, because a company could be poorly managed, but they're still in the energy sector. So that's something to be very mindful of as an investor. Real estate is another investment area. Real estate is a super broad investment asset class, right? It's massive. But if we look back in the CPI weighting, we know it's very important. About a third of the CPI is allocated to shelter. And I keep saying the word shelter because the BLS actually looks at the rent and the livability and what you're paying towards a rent. They do not look at the actual cost of the physical building or the property taxes. They consider that more of a capital asset. And if you're an owner of a house, when you own a house, they look at it as an asset. And so a car for the BLS is considered a consumable, because even though there might be a car market where used cars could go up and you could make money on your car, you tend to not make money on cars. So the BLS is looking at the CPI index as a consumable thing, and you can't consume a house because it's an asset. It's going up. You consume bread, and the bread is gone. The house isn't gone. You're having this capital asset that might have appreciation. And so that is why the BLS doesn't consider housing, the ownership of it, as part of the CPI. They just look at the rent of it. The other thing is they're looking at residential, right? So there's many different areas of real estate. And so if you're going to invest in real estate, there's a few ways to do it. You can buy direct real estate, right? So you can buy a residential home, you could buy a commercial space, but remember, now you're in different pockets and you're in a whole different ball game when you're now doing commercial versus residential. But the CPI index is really looking at the consumer's perspective, right? So keep that in mind. Another area though in real estate that's very easily accessible to investors is REITs, real estate investment trust. So you can buy companies or stocks that have ownership in real estate. And so their job is to buy, rent, own, develop real estate. Inflation protected securities is another investment idea. Inflation protected securities are anything that's linked to inflation. One of the very popular ones is TIPS, which is Treasury Inflation Protected Securities. So the US Treasury has debt. You can buy their debt. You can buy debt from the US government that is linked to inflation. So as inflation goes up, your investment goes up. Another inflation protected security is I-bonds, which is similar to TIPS, but there's some nuances. I-bonds have caps on how much you can purchase. You can only purchase $10,000 of I-bonds, and then there's some caveat to where you can purchase another $5,000. So you really max out $15,000, but that is also linked to inflation. So that would be another inflation protected security that you could link to with inflation. Lastly, I would like to talk about is crypto. So crypto remains to be seen if it's exactly correlated or if it is connected to inflation. Crypto is such a new technology. We don't have a lot of data to say, hey, crypto's been around 100 years, to see how it acts under all these different inflationary environments. However, if I was to postulate and think about, does it make sense logically from an economic standpoint of view, I could see where there are certain cryptocurrencies that could be correlated to inflation. Bitcoin, which is obviously one of the most well-known cryptocurrencies, has a fixed supply of cryptocurrency, and it's completely fixed. So you could have that become kind of like a quasi-digital gold. You have this fixed supply of something. It could correlate to inflation, but this is where it gets a little tricky, is because cryptocurrency, there's so many tokens, there's so many coins, they also all have different uses. So you might have another coin, and it might be a cryptocurrency coin, but its function is not really to function as a form of payment. It might be functioning as some other sort of form of something else, right? And that is where you might not have as much correlation with this idea of inflation, and that remains to be seen.